So when you track your results, you've got all this data, as far as your trades, and can we use that in a way to kind of give ourselves like a grade, right? Or a measurable number that we can look at to see if we're improving or how well we're doing and how much we can expect to make on each trade. And you can. It's a very important measure, simple to calculate, called the expectancy ratio, and that's what we're going to talk about here. And your expectancy ratio is based on the set of indicators you're using. I mean, that's your trading indicator plan, so you're using that with your plan. And the whole goal of the expectancy ratio is you want to see how much you can expect to make on each trade. If you do 50 trades, you would know how much you would make on average on each of those 50 trades. Some of those trades are winners, some of those trades might not have worked out as well. Either way, you're going to have, they'll go into a calculation, the expectancy ratio, so you can kind of get a feel for how well you're doing. And the expectancy ratio is simply looking at your average profit, how much you make per winning trade, times your winning trade percentage, right? How much percent of the time are you winning or profitable? And then you subtract out of that the average loss per losing trade. That's where your stop loss orders can help minimize that, times your losing trade percentage, right? So a pretty simple calculation. So if we looked at, let's say you're using an indicator as an example, we'll call it indicator set 1 here. So this is your indicator you're using. It could be whatever combination of indicators. We're just going to call it your primary and secondary. Let's say there's a third as well. But that's your indicator set 1 that you're using and that you're really committed to. And let's say, again, whatever currency you use, just submit different numbers. I'm using dollars here. But let's say that your average profit per winning trade is $800. That's pretty good. That's okay. Times 35%. Your winning trade percentage is 35%. Well, that's not great, so you would love to be above 50%. So you can already see this might not be so good for us, but if we can minimize our losses, maybe it won't be so bad. And we do. Our losses are only $400. So our wins are $800, our losses are $400. So that's a good sign. Though we do have more losses in this indicator set we're using. 65%, again, it's going to add up to 100%. 65% is our losses. So you do the math and you see 280 minus 260 and you get $20. So what you can expect to make per trade is 20 units or $20. And you may say to yourself, well, that's not that great. I could do better. Maybe you're looking at that. So this is where you want to adjust your indicators, track those results, and then try a different set of indicators on that. So let's say we did that, and we now have indicator set number 2. We're not using number 1 anymore. We're trying a different set of indicators, and we're tracking it separately to see how well we're doing. We want to get to that expectancy ratio. How much can we expect to make per trade? So let's say in this case, we're using a different set of indicators. Maybe we're being a little more conservative on the profit side. And so we're making less profit per trade. We're making only $600 instead of that $800. But you see our winning percentage in this example went up significantly. Now we're at 55%. That's not knocking it out of the park, but that's pretty good. So we're above 50% at least. And then we're still minimizing our losses. In fact, we actually reduced our losses a little bit to $300 per trade, and our percentage is down in there too. So then you do the math, you can see 330 minus 135, and we come up to expectancy ratio of 195. Much, much better, right? Now we're making 195 per trade, and you can keep adjusting your indicator sets or keep tweaking this a little bit until you can get to, expectancy ratio that's working for you, and you can kind of repeat this over and over as the idea. But right now, let's say we're at 195. Thus, if I was to make 100 trades over, however time period, a month or 2 months, however often you trade, maybe a day if you're, fast, doing lots of trades, you can expect to make, 19,500, right? So that's 100 times your expectancy ratio of 195, 19,500. Thus, when I get to 300 trades, I'm going to be at 58,500. So again, you're going to have some wins and you're going to have some losses, but when you look at the difference between them in calculating your expectancy ratio, then you can kind of see what your your potential profits would be and see if you're doing that. Now, you can make that number even better, of course. I mean, if you increase your win percentage, right, and you're winning more trades, or the amount per trade that you're putting in, especially on those winning trades, is higher, you can increase those amounts. Note, it goes the opposite way. If your loss percentage increases, or you decrease the amount committed per trade, then it would, it's all mathematical at this point as far as your expectancy ratio. And then again, a reminder too that if you like that and you say, I can do even better, and you change to a third indicator set, well, then everything changes. Now you need to start tracking separately under indicator set number 3. And let's say your indicator set number 3 does great, it does 250 expectancy ratio. Well, now you've got a new indicator set. But if you do your indicator set and you give enough time to show whether it's working or not, and it's doing less than that 195, well, then the smart move would be to go back to that indicator set number 2. As far as, certainly maximizing your profits around that. So hopefully you can see here how powerful it is to know your expectancy ratio. You know your wins, your losses, you know your scorecard, and you know that every time you make a trade, even if you're not so sure about a trade, you can say, well, I expect to make this much per trade. I know I'll lose some. I know I'll win some that'll go well above, let's say, the 195 in our example. But in the end, I know, in using this example again, I know that if I use this indicators that I put together, my primary, my secondary, maybe some other ones with it, and I can expect to make, as an example, 195 per trade. Well, that's a powerful kind of confidence boost, but also it's a great money management way to say, am I on track or off track? Or if I start changing my indicators, what impact is that? So understanding your expectancy ratio, tracking your results, calculating expectancy ratio can be very, very powerful, and I would certainly encourage you to do it.